Welcome to The Explainer. So, you've probably heard people talking about using options to make money from their stocks, and maybe you felt a little bit lost. Well, you're in exactly the right place. Today, we're going to cut right through all that jargon and show you how these powerful financial tools actually work. It's a question a lot of investors ask themselves. How can I generate a little more income from the stocks I already have in my portfolio? You hear about options, but man, the complexity can feel like a huge wall. So, let's clear that path for you, shall we? Okay, so here's our game plan for today. We're going to start with a really simple analogy to get the main idea down. Then we'll get into the two basic tools you'll be using. After that, we'll look at a popular income strategy called the wheel, cover the biggest mistakes you have to avoid, and then wrap it all up with the most important piece, your trading plan. All right, first things first. To really get our heads around options, let's just forget the stock market for a second. We're going to kick things off with a simple analogy from the real world that makes it all click. Okay, so at its heart, an option is really just a contract. That's it. It gives the person who buys it a choice, the right to do something, like buy or sell a stock, but it doesn't force them to. And that phrase right there, the right but not the obligation, that is the absolute key to understanding everything we're going to talk about. And honestly, the best way to think about the two types of options is with a couple of simple analogies. A call option, that's kind of like putting a non-refundable deposit down on a house. You're locking in today's price because you think it might go up, giving you the option to buy it later. A put option, on the other hand, is a lot like buying an insurance policy for your stocks. It's there to protect you if the value suddenly drops. All right, so with that house and insurance idea in your head, let's dig into the actual tools you'll be using, calls and puts. All right, so a call option. This is your tool for when you're feeling bullish. You think a stock's price is headed for the moon, so you can buy a call. This gives you the right to buy that stock at a lower, pre-agreed price. And here's the cool part. The more that stock goes up, the more valuable your call becomes. The potential upside is, well, pretty much unlimited, while your risk is capped at whatever you paid for that option. And then you've got the put option, which is, you guessed it, the exact opposite. This is your bearish tool. If you think a stock is about to take a nosedive, a put gives you the right to sell it at a higher pre-agreed price. Just like that insurance policy we talked about, it pays off when things go south, which makes it a really powerful way to protect your portfolio or even profit from a downturn. Now, this right here, this is maybe the single most important distinction you need to get. If you buy an option, you're paying for a choice, for a right. Your risk is totally limited to what you paid for that contract. But the option seller, that's a whole different ballgame. They're getting paid to take on an obligation, and that means their risk can be, well, a whole lot higher. It's a fundamental difference. Okay, so we've got the tools. How do we actually use them as sellers to make that income we were talking about? Let's break down one of the most popular strategies out there for beginners. This quote from a user on Reddit just nails it, doesn't it? For so many people, the goal isn't to get rich overnight. It's about finding ways to create a consistent, repeatable stream of income from their investments. Okay, so the first piece of the puzzle is something called a cash-secured put. Here's how it works in plain English. You find a stock you'd be happy to own, but you think the price is just a little too high right now. So you sell a put option at a lower price, the price you'd actually love to buy it at. And for doing that, you get paid a cash premium right up front. Now, one of two things happens. Either the stock stays up and you just pocket the cash, or it drops and you get to buy that stock you wanted anyway, but at your target price. It's a win-win, really. Then you've got the other side of the coin, the covered call. Let's say you already own at least 100 shares of a stock. You can sell a call option against those shares. You're basically getting paid to agree to sell your stock at a higher price in the future. Once again, you get paid a premium just for selling the option. If the stock doesn't climb up to that price, great. You keep your shares and you keep the premium. If it does go up, you sell your shares for a nice profit. So when you put these two strategies together, what you get is this really cool cycle. You sell cash-secured puts to try and buy a stock at a good price. Once you own the shares, you start selling covered calls against them to generate more income. Round and round it goes, and this entire process is what traders famously call the wheel strategy. Okay, hold on. Before you get all excited and rush off to try this, we need to talk about the pitfalls. Seriously, this is critical. Knowing what not to do is every bit as important as knowing what to do. Actually, Fidelity did a bunch of research on this, and they found 7, count them, 7, common mistakes that just totally wreck new options traders. These are the traps you absolutely have to be aware of. Now, all of these are super important, but let's zoom in on a couple that really, really trip people up. Number 4, ignoring volatility, and number 6, just staring at that profit graph like it's the only thing that matters. Okay, first up, volatility. Ignoring this is a huge mistake. Think of what they call implied volatility as the market's fear gauge. When it's high, it means the market expects big price swings, and that makes option prices more expensive. That's fantastic if you're a seller, but it can be a disaster if you're buying without paying attention. It's like setting sail without checking the weather forecast. And that other big mistake, it's thinking that your profit or loss is just this one number on one future date. It's not. Nope. The value of your position is changing every single day, every hour even, based on the stock price, time, and that volatility we just talked about. A trade that looks like a winner today could be a loser tomorrow, long before it ever expires. And that leaves us to this perfect summary from another Reddit user. Without understanding these risks, even safe income strategies can feel like you're picking up change before a steamroller. Those small, steady gains you're making can get completely wiped out by one single unexpected loss that you didn't see coming. Which brings us to what is, without a doubt, the single most important part of this whole explainer. To avoid becoming that steamroller's victim, you absolutely, positively must have a trading plan. Think of your plan as your business plan. It's your rule book. It takes fear and greed right out of the equation and replaces them with a logical, repeatable process. A good plan spells out exactly how much you're willing to risk, how you find your trades, your specific rules for getting in, and, most important of all, your exact strategy for getting out, whether it's a win or a loss. So at the end of the day, options aren't a lottery ticket. They're not a get-rich-quick scheme. They are an incredibly powerful and flexible tool, but for the disciplined investor, the prepared investor. You've got the basic tools now. You understand the big picture, the strategies, and the risks. So the real question is, what's your plan going to be?